Welcome to CFA Corner, the video series where we dive deep into the world of finance with Timothy Fitzwilliams, founder and CEO of Fitzwilliams Financial, and Ron Wright, the firm's portfolio manager, where we're unpacking the latest trends, insights, and strategies in the world of finance. Welcome, Tim and Ron.
Welcome everyone to another CFA Corner. This is our June edition. I'm Tim Fitzwilliams, owner and founder of Fitzwilliams Financial, and we're joined by our portfolio manager, Mr. Ron Wright, chartered financial analyst, and overall Superman to our portfolio. I know you love it when I say that. So let's just talk about some things where we left off last time. We were excited about the potential for bonds. We're still excited for the potential of bonds, but we've kind of taken it a little slower now. Want to help us out in understanding about why that is now?
Yeah, of course. And when it comes to interest rates and bonds and everything that's going on with the Fed right now, it's almost that there's so much hype around everything, you just don't know what's going on, what direction to take. And I don't think even the Fed governors know exactly what they're doing. But what we do know are a few things. We know that, number one, they're done hiking interest rates. That's done. Number two, the next direction is going to be down. They're going to be cutting rates. What we don't know is exactly when. So we were anticipating at the beginning of the year, almost every economist was anticipating 3 rate cuts this year and 3 rate cuts next year. Over the course of this year, in just a short 5 months, that went to no rate cuts this year, and maybe a couple next year. And now we're back to probably 2 rate cuts this year and 2 to 3 next year. So it's just a matter of exactly when down the line this is going to happen. So on the long run, it doesn't change our perspective on this opportunity in bonds, which is we just had the worst bond bear market in history. Right. And now we're at the bottom and we're ready to be able to take advantage of the recovery in those prices as yields come down. And so that's what we're waiting for. And really, it looks like we could still get, over the next 2 or 3 years, those stock market-like returns from the safe treasury bond market. So that opportunity is there. It's just slower in coming than we hoped it would be. And that's a little frustrating.
That had to make a change, right? You had to make a change.
Yeah, absolutely.
The timing wasn't there. And
absolutely.
So you don't want to just sit stagnant because you're active and tactical, which is great. So don't worry, you weren't stuck in that position. Right.
Exactly.
You move things around.
Exactly. So we made some transition. We made some shifts, reduced some of that exposure to bonds in favor of stocks, which are doing much better on a relative basis right now, because we always want to have the portfolio, everybody's money, working for us. We don't want to just be waiting around for the next thing. We want to be doing something where it's employed actively and it's getting some return for everyone. So, for example, some people would say, well, you could just stick it in stock A, and it doesn't matter if it drops 20% in the next 2 years because I know in the next 5 years it's going to be up 100%. Well, actually, that 20% down does matter. We don't want to do that. We want to. It would be better to stick it in a money market fund for 2 years, and then check back in later when it starts really moving up and it's going to make the gains.
Back to our original theory of just making sure that we take less losses and we don't just take that lightly.
Yeah, exactly. So what we did within all of the strategies is, looked at where we are, what's going on, and so we've made a shift to be a little more tactical, which means our clients will see probably a lot more trading taking place in their accounts because we're looking at what's going on and where can we best position everything to make those returns for the short term.
You're hunting. We're
hunting a little bit, knowing still what our objective is in the long term.
And we kind of talk about this, and it might kind of leads right in because of the word hunting. But we're also hunting in the fog amidst all the headlines and everything that's going on out there. It's a little hard to find the play right now.
Right.
Like you said, there's no definitive way that the economy is going.
Yeah.
Things have slowed down, but there's no easy to see horizon.
Right. Yeah, we were talking about this the other night, that it's about like driving on a mountain road in a fog bank.
Right.
What's you've already passed because you've seen that. You know what's right in front of you, but what's 50 50 yards down the road, maybe there's a turn to the right, maybe there's a turn to the left. You're really not sure, and that's where the anxiety comes from. And that drives a lot of other behaviors in the financial markets right now. And probably the biggest of those is this fear of missing out.
There's that
Right.
big neon sign on the highway saying, eat here.
Yeah, yeah, exactly.
Right.
Don't you wish you were making as much as this
Exactly.
guy made?
So
And
that fear of missing out and the headlines there. So that you put out a really good newsletter recently, and if you don't have it, you can reach out to us. We'll make sure you get a copy. But you talked about that, and,
Yes.
and you explained the logic of that. Do you want to speak a little bit to your gamification and
Yeah.
the rational reactions that are associated with that?
right, so
Or irrational?
yeah, so one of the things that's going on in the marketplace right now, and there's actually a lot of study that's happening around this, is the idea of gamification of the marketplace. In other words, we make stock investing start to look like it's a video game. And we were just talking earlier, my best example of kind of where this comes from is you take your kid to Chuck E. Cheese's. And, you know, at first they're all excited, hey, I'm going to see Chuck E. Cheese, we're going to have pizza and the party, but that's really not what they want.
That's right.
What they want is to go to the games and put in the quarters and play and get those tickets so they
Yes.
can go get the prizes. And then they see that they didn't get the bigger prize that their buddy got, so they want more money to go put in to get more tickets so they can get the next prize.
Absolutely.
And there's that drive there that keeps pushing the cycle of the gaming that's going on. And you know, it's fun when you're doing it in a video game. I know you're a big gamer and really enjoy that, and it's fantastic. There's nothing wrong with that at all. But when you take someone's livelihood and you start putting it into that context, that's a very different thing.
dangerous.
It's very dangerous. And there's nothing more wealth destroying than to think that this is just play money. This is monopoly money. And, you know, I can do whatever I want and I'm going to be okay, because it's not. But a lot of these platforms are doing things like creating incentives. If you bring another client to open an account with our platform, we'll give you a share of stock. And if you do this many trades this month, we'll put you up on the leaderboard. Or they put bulletin boards up for who's doing the best, you know, so everybody's challenging each other and everybody's
Yeah, that's
trying.
the game part.
Yeah, that's the game part, and it completely takes the perspective away from what are you doing with your money? What's the point of this? Is this just going to a casino, or are you really trying to build wealth? And that impacts everything about your life in the end.
Yeah, that's scary. When you're right, emotion starts to take over.
Yeah.
Logic goes out the window. You let the memes and the headlines and the subreddits and all the different things that are out there start to slowly drip on you.
Right.
And thinking, man, if they're doing it, why can't I?
Right.
You stick your toe in, maybe you try, you know, a small percentage of your portfolio at first. But then, you know, we've seen it. We've had people come to us and say, hey, I want to pull out 25% of what I have with you because I'm going to go to this option seminar.
Yeah.
The only reason you want to go to the option seminar is you think that you're going to go make more. So
Exactly.
what I always say, Ron, if you really feel that way, go open a business and invest in yourself.
Absolutely.
Search your heart, your soul. What do you really love to do? What are you passionate about? Or what is someone that you love and care about or you feel really close to is passionate about? And support their structure. Maybe your best friend is a chef and has always wanted to open a restaurant. Well,
Yeah.
fine. Then
Yeah.
it's better to do that where there's a connection and comparative advantage, that whole do what you do best, right? And you're supporting it by funding it. At least you're doing that in such a way that you have some control.
Right.
Whereas
Yes.
this other concept, you're just out blind. You don't know what's going to happen. The next meme happens and you're in, and 4 a.m. in the morning they post something different and now you're out.
Exactly.
I'll never forget what happened when I tried to play in the IPO world. You know, I got burned. I mean, I literally went to class during the dot-com bubble, and I knew I needed to get out. That was the whole play. But I didn't think by the time I got out of class that it would have already crashed, and it crashed in that short period of time.
Just that fast.
that fast.
Yeah, absolutely. And those are those kind of movements that we're seeing in the market these days too. I mean, we're seeing a resurgence of the meme stock
Right.
phase, right? So the Roaring Kitty
Yeah.
guy, Keith Gill, is back in. Who's been stripped of all of his licenses.
But still gives advice.
And he made his appearance back on the Reddit bulletin boards and actually kind of preloaded his account, then made his appearance, and now pushing GameStop up to new highs and is making a lot of money ostensibly on paper.
Yeah, it's a good point. We talk about that more in detail on our recent podcast. So if you want, and you're one of our clients here for the CFA Corner, but we also have a podcast now that you can get in on that as well. We can make sure that you get access to that. I don't know if there's going to be a link on here or not, but we're going to make sure that you have that in the next newsletter so that you can follow along. Right. We'll get into more detail about the meme stocks and that. And I think that might be fun for you to hear about how we look at it as a whole and what's happening in that arena.
Right, absolutely.
With the gamification.
Yeah.
And the reactions and the fear of missing out, fundamentally sound things then start to look not as attractive.
Yes. Yeah. Because
Right?
you lose sight of what really underpins the value of a company or an investment, and you get caught up in the hype around things. Is there something that suddenly happened to GameStop that made it worth 60% more than it was yesterday? No. There's nothing that changed in their business whatsoever. On the other side, we've got some really some big drops that are happening in very solid companies.
Fundamentally solid companies.
Yeah,
Not
yeah.
overpriced.
Exactly. Salesforce is an amazing company, well run.
Sure.
Slightly missed their expectations, and the stock was sold off 20% in one day. A few days after that, Dell Computer, who was actually part of the AI trend and boom, they build the AI server farms, and they're probably NVIDIA's biggest customer, or at least one of. Same kind of situation there, sold off 20% in one day.
Doesn't make any sense.
They
But
weren't
don't worry,
suddenly
folks,
a bad. Yeah.
We didn't even feel that, right? Because
No.
we believe in diversification.
Right, and there is a key. We've talked a lot about how the Magnificent Seven and all these big, huge stocks are overloading the indexes, and how the top 10 stocks make up 1/3
That's what it is now,
of the
1/3.
S&P.
Wow.
Yeah, 1/3 of the
That's
S&P
crazy.
500. So 5% makes up
So
1/3.
just to put that in common sense, if a 70-year-old person walks into our office and says, I want to follow the S&P 500, they're really saying they want to be on the trendiest, most radical, cutting-edge stock you can possibly find.
Yeah, that's a really good point.
I just
Would
kinda
they
thought
walk
about
in
that.
and
I was
say,
like, wait a minute,
Right.
that's what you're saying now when you
Right.
say that. It doesn't mean what it meant 30 years ago.
Right. Yeah, you're saying I want to buy tech stocks. I'm a
Yeah.
70-year-old retired person,
Yeah.
and I want to buy tech stocks.
And if you're saying I want to follow the trend of the S&P, you're saying that you want your portfolio to do that. Not a smidgen, not a piece, not a part, but the whole.
Right.
When you start to think like that, that's dangerous
Yes.
because your risk tolerance doesn't match that. We have
And-
very few
right.
clients that actually can afford or want their risk tolerance to be at that level.
Right.
Because that would be at the higher end, wouldn't it?
Yeah. Yeah.
I mean, we're not talking 60-40 here. We're
No, no,
talking,
no. No, because the
aggressive.
volatility of those stocks, so there's a saying that says when the stock market, when everything falls apart, all correlations go to one. What that means is everything that seemed to be going its own way, all of a sudden, everything gets sold. Right.
Right.
So, but the ones that come down the hardest are the ones that seem to be the darlings.
Inflated.
Yeah, exactly.
Right.
So that's why we diversify, and that's why
so
we
key.
don't hold those kinds of concentrations of those stocks.
And you don't have 10% of one of these types of things or anything like that. You try to stay very thin in terms of the amount of
Absolutely.
shares.
Absolutely.
So
And we
that way you
monitor
can
that.
Take a punch and keep
Yeah.
on going.
Exactly. We monitor that carefully. People don't realize, and I call this, stealth risk that gets built into
Mm-hmm.
a portfolio because they might hold mutual fund A.
I got that from you. You used it last night.
Yeah,
at the
you used it
seminar.
exactly.
Exactly.
They might hold mutual fund A, which is a large cap growth fund, and then they buy mutual fund B, which is another growth fund, but
Right.
maybe sounds like a different title. But when you look at what's in the portfolio, suddenly it's all the same top 10 stocks, and now they're super concentrated in those, and they had no idea. but they're really much more
Because
at
they
risk
feel
now.
diversified because they have different names.
Exactly. Yeah, I have. What do you mean? I have 7 different mutual funds. Yeah, but they all hold the same
How
thing.
many people read the prospectus, right? How
Right.
many people actually go into the holdings and pay attention to reports and stuff? I mean,
Right.
seriously pay attention.
Right.
No. They're not going to know the holdings. So that's true. If you're in a big box shop and you've got, your husband has a mutual fund and you have a mutual fund, there's a high probability you both might have Apple.
Yeah. And Microsoft. And
But at our firm, that's not the case. We're going to make sure that if it is like that, it's a very, very small piece,
Right.
if at all.
So within a diversified portfolio, we tend to, we try to make sure we don't hold more than 5% of any one stock ever. We shoot for no more than 2%.
Love it.
And that's
True
what
diversification in your opinion.
yeah, that's where we're shooting for, yeah.
Fantastic. Well, I know right now our current holdings with this fog that we talked about is ever changing, but if you can kind of just roll us out with a snapshot of the current positions that we're really focusing in and where you think we're heading.
Sure.
Everybody always love to hear that, although at any given moment it can change because
This
we're in
is
the
true.
fog.
And we are more tactical now.
And that's why you're looking at it every
So,
day. And,
right.
and,
Yeah, absolutely.
Active, and that's the value, right?
Yeah.
That's the value of having an account with us is you have a portfolio manager who is constantly active and tactically looking at the portfolio and not just waiting for your quarterly review.
Yeah,
So
exactly.
with that being said, what are the positions that we have and where do you think we're going?
So in terms of bonds and income, we are shifting more towards high yield bonds, which should provide a much better return on a relative basis compared to the government bonds. So that was the shift that we made as it seemed like that interest rate cut horizon was being stretched out. So we're sitting there. We're ready to move back when need to, but this is giving us a
Finger on the
good
trigger type of thing.
Yeah, that exactly.
I got it.
Yeah, I guess I should say if I was to describe the whole picture right now, we're fully invested, but every day I'm sitting there with my finger on the sell button, waiting
There you
for when I need to
Love
go,
it.
because it's in some ways it feels when you have things happening like what happened to Salesforce and Dell Computer,
Which is out
great
of the
companies.
blue.
It happened to Apple just a couple of quarters ago. These things happen. We need to be ready, and so we are. We're watching for it. So our current income strategy, which is really based around just providing income for people in retirement, that doesn't move a whole lot, but heavily invested in real estate and also in utilities, these income generating things, and it's yielding right around 8% right now, which is a phenomenal, dividend
Absolutely, yeah.
yield. For our equity-based strategies, we're into really where we have to be to just kind of keep pace with everything, which is a lot of the large cap growth and pretty heavy weighting in tech stocks on the sector side. But we're also looking at some other things that show real potential. For instance, the home builders show real potential long term, especially because there's such a lack of supply in that market. And if we do see the interest rates coming down, that's going to buoy
We'll
those
see
all
that
the
come
more.
right back on up, just like the bond play.
Exactly.
It's another play around interest rates.
Exactly. Another play we have there is we have about a 10% weighting in precious metals.
Okay.
And a lot of people think that that's an inflation hedge. But the reality is that gold is really a contra dollar trade. So when the dollar goes up in value, gold tends to go down. Well, and the vice versa is also true. The opposite is also true. If the dollar starts sinking, then gold is going to be going up. So we took this position in anticipation of rate cuts. As rates get cut, then the dollar is going to go down.
Yeah.
Gold is going to go up. And so far,
Makes sense.
even though we haven't seen a great materialization of interest rate cuts, that's been a really good position
You
for
got
us
three
too.
good ideas that you're waiting to pull the trigger on. Sounds like you got the bond play around the interest rates. Sounds like you got like the real estate market around the interest rates, and it sounds like you have the gold play around the interest rates, and you're
Yeah.
kind of seeing which one's going to work and how.
Yeah.
And that's going to be some tools that you might implement here soon. Who knows when, but we're waiting on those rate cuts. So,
Right.
last, let's kind of touch on that. When do you think we're going to see a rate cut now?
So, it depends on the day and
Right.
the report that comes out
Sure.
in this fog that we've got going on. But my position is that we're likely to see the first rate cut in September,
Okay.
and there's a virtual 100% certainty that we'll have one by December. So we'll get at least one, but I think we're going to get two this year.
This year, quarter basis points.
Yeah, I think two this year,
maybe,
September and
so
December.
50 basis points,
And yeah, quarter point each, and then 2 to 3 more next year.
right.
And we'll see where we go from there.
CME to, right? Isn't that what you said?
Yeah, I watch the futures contracts on the Fed funds to see where the market is trading, to get a feel for
What people think.
what people are anticipating is going to happen, and then I factor into that where I really think the economy is going. So, in terms of interest rate, one last thing that is coming up, you're probably going to start hearing a lot more about it, and we talked about it a little bit, but there's a lot of talk right now that we might actually see a drop in interest rates be helpful or actually pull back on economic growth, which is the opposite of what you would think.
Yeah, right, yeah.
Right? High interest rates should be restrictive. And
Harder to get capital.
Harder to get
so on
capital.
and so forth,
And the reason why this is being brought about is because during the pandemic, there was so much cash that was put out, people reduced their debt levels to almost nothing. They refinanced all their variable rate mortgages to fixed rate.
Sure, yeah.
All the
2-3%. Yeah.
companies have the most cash they've ever had on their balance sheets. And people who had high yield bonds and these junk bonds that you heard about, they all reinvested those things into lower rates because
You could.
they could do all these things. So interest rate increases are actually having much less impact on that side of the economy. But what it is doing is it's giving people who have cash and savings and corporations who have a lot of cash on their balance sheets, now suddenly they get risk-free 5% returns. And so they have more money to put out there. And they put that into, higher income people do things like travel. They go out to eat more. They put it into the service economy. And that's where we're having a problem with inflation right now. So higher interest rates
That's where you're
have
seeing-
actually given more income to higher level.
So you're seeing service industries a little inflated.
And the services, that's where
Interesting.
the inflation is staying up.
Right.
Goods are almost back to pre-pandemic levels, that rate of inflation. And housing is coming back down too. But the services inflation, that's the sticky part, that's the problem. And it could well be because we have high interest rates.
That's a big part too.
And so it could be that the Fed actually, crazy as it sounds, might have to lower interest rates in order to reduce that inflation.
And what percentage impact or what portion of the economy do you think the service industry makes up?
Service is a large part of the economy, and
that's
it's
what I'm
really
thinking.
consumer spending is the largest part of the economy, and so we spend in America we spend a lot of money on services. So
Wow.
that's a big.
That's a major factor.
Yep.
Well, great, Ron. As always, we appreciate you coming out here and
Thanks,
chatting
Tim.
with us and whatnot,
Yeah.
and giving us some advice on what's happening in the economy and what you're planning to do. So
Great.
we thank all of you as well for joining us today for our CFA Corner, and we can't wait to see you next time. Take care, and God bless. Bye, folks.
Bye.
Behavior.